Hi and welcome to another Mr. James accounting tutorial. Today we'll be looking at the 2021 paper 2 of unit 2 and we'll be looking at module 1. So let's get right into it. Question 1, part A requires that we outline three differences between the FIFO and the LIFO inventory valuation methods for 6 marks. Okay, I've given you here three differences. First, LIFO allows businesses to use the most recent inventory costs first, while FIFO uses the oldest cost first. And two, that should be LIFO computes a lower gross profit in general. And three, LIFO assumes the oldest products in the inventory are sold or issued first. That is just an assumption. It does not necessarily follow that you are going to sell your old stuff last and the new ones you are going to sell them first. We read what is required first. Compute each of the following costs at 30th of May 2019 using the FIFO method. And then inventory costs and the cost of goods sold. We have two things for 8 marks there. And then part 3, compute the gross profit for Trelawney Incorporated using the FIFO method of the items sold during May were at a sales price of $11 per unit for 4 marks. And let's take a look at the data now. We are given some data in a table here. We are told that Trelawney Incorporated uses a periodic inventory system. The company reports the following for the month of May 2019. So it's not a perpetual inventory, otherwise we'd have more information than this. We will just have the purchases and the inventory taken at periodic point in time. On the 1st of May and the 30th of May, the inventory is counted. We got 120 units here and 230 units in stock at the end of the month. In between, we bought 370 on the 12th of May and 200 on the 23rd of May. And we are given the prices here and the total cost of the inventory. We are not given the cost of the uh, closing inventory at the end of the month of 230 units. And this is what we are going to value, the 230 here. Okay, so let's get right into the answer. Okay, so the closing stock consists of 230 units. And if we look at the cost of those units, which 200 was at 7, and then before that, we would have purchased 30 at 6. Okay, so we can only get 200 at the $7 and 30 at 6. The total here is 230. It would be the last two that we bought, the last two prices. Uh, if you could have gotten all 230 at the $7, the stock value would have been a different price. But we only bought 200 and that remained in stock, and of the previous amount that we bought, 30 remain in stock. So we add the two together and we get 1580 for the closing stock. In order to do the next part of the question, you're going to have to find the opening stock. And the opening stock was bought at $5. We have 120 units, so that will give us 600 for it. To get the cost of goods sold, we will add the opening stock to the purchases. We have two purchases in the table. We add them together, we get 3620. Our goods available for sale would be 4,220. We minus the closing stock, 1580 that we got up here, and we will get the cost of goods sold being 2640 when we're using FIFO. Okay, now part 3 asks for the gross profit. Okay, in order to do that, we have to find out the sales at $11 per unit. So first we take all the units that we had in hand at the beginning, and then we will add to that the two that we purchased, 370 plus 200, and then we minus the amount that we had at the end. More or less the same thing that we did with the cost of goods sold, except this time we are using the units. So okay, so we get 460, right? This was unsold at the end of the month, so it means these were sold. Okay, these, sorry, that should be these minus the 250 was sold. It was 460. Right, so the sales at the selling price of $11 would be the 460 here, multiplied by $11 equal $5,060. In order to get the gross profit, we simply take the sales and we minus the cost of goods sold from the part 2 of 2640, and we get the gross profit of 2420. Okay. Let's take a look at the next part. Part B asks us to compare the impact on the gross profit of an enterprise using the FIFO and LIFO methods during 2 years of inflation. Okay, to explain this a bit, periods of inflation means that the price of the stock is increasing. Every time you purchase at a higher price. Okay, now if we look at the data that we are given, we notice the price column, we would see that the price has been increasing. So we have an example there in the data itself, right? And we already use FIFO to compute it, so we can in fact use the data there as an example and see what happens. Okay, your answer for part B should have looked something like this. Periods of inflation are periods of increasing prices. In part A above, they are increasing prices, 5 to 6 and then to 7. Okay, we have calculated the gross profit at 2420 using FIFO. If LIFO was used, the closing stock would be 120 by 5 plus 110 by 6, which is equal to 1260. In other words, what would happen is the closing stock of 230 units would be taken at the earlier prices for LIFO, and you would get 1260 units. And the cost of goods sold would be 600 plus the purchases of 3620 minus the closing stock. The only thing that would change is the closing stock to 1260, and we'll get this here 2960 as the cost of goods sold. Our sales would remain the same at 5060. I want to minus the cost of goods sold here. We would get a gross profit of 2100 compared to the gross profit that we got for FIFO. So this is less than gross profit under FIFO. Therefore, we can conclude that in times of inflation, FIFO will give a higher gross profit than LIFO and vice versa. Okay, so you had there, perhaps you didn't notice that the data given was giving you a period of inflation, 5 to 6 and then to 7. What you would have probably went on to do was make up your own example, and it would not work because you would have had to do it twice, the same set of data with FIFO and LIFO. I think what the examiners had in mind here was for you to use the same set of data to calculate the LIFO gross profit as we did here, and then compare the two. We will notice that the gross profit under FIFO would give you a higher gross profit than LIFO. It would be the other way around. If you have fallen prices or decreasing prices, then LIFO would give you the higher profit, and FIFO would give you the lower profit. So we want to look at Part C, outline the two main differences between cost allocation and cost apportionment. Right, now in order to do this problem, you have to know the definition for both of these items here. And there is a very thin line between the two actually. Our approach to it should be to first define cost allocation and then define cost apportionment. Then you can mention the two differences that you have there. So we will do that now. Cost allocation. An item of cost is allotted to a single department or cost center incurring it. An example of that could possibly be something like rent. If you pay rent for a department, an entire department, you would allot the cost of the rent to that department or cost center that incurred it. Cost apportionment, on the other hand, an item of cost is divided between two or more departments incurring it. So where you have two or more departments involved and both are using the service or the course, then you're going to have to apportion it or divide it between the two departments. Okay, now let's take a look at the differences between the two. Allocation is to a single department. Apportionment is to multiple departments, two or more. Allocation deal with whole items, of course. Apportionment divides whole items, of course. Okay, so these are the two main differences that you're going to have with allocation and apportionment. There's another a word here for cost that is called absorption, which has to do with the ascribing of cost to units. Okay, so that is not included here. You shouldn't have had that in your answer. So we move to part D, which appears that the topic has changed here. Let's see what is required first. Calculate the amount of overhead costs that will be assigned to each production department. So, right, so it's going to be about cost allocation and apportionment. Okay, let's see what the data says. Tops Manufacturing Corporation operates a manufacturing plant with two production departments, blending and packing, and two service departments, a, com- a, canton, a common canteen, facilities, and the warehouse. Information associated with the manufacturing plant is shown in the following table, and we have it here. We have a column for each one of the departments. These two in the end are service departments. They are not production departments. So you don't have any units of the product being manufactured here. So what has to happen is you have to take the cost from here and allocate them and apportion them to these other two here. And we do it on the basis of the number of employees or the number of orders. Now, if you look at the table itself, you will not be able to answer the question. You have to look at carefully at what it says in the additional information here. The company allocates the cost of the service department in the following order: canteen based on the overall number of employees, and warehouse based on the number of orders. Okay, Tops Manufacturing uses step-down method to allocate service department costs. Right? So if you didn't know what the step-down method is, you could still go ahead and do the problem, but most likely you would get it in the wrong order. Or since the order is given here already, you may not use the step-down method and you may use what is called the elimination method or the direct method. Okay, so with the step-down method, you look at the thing here and you decide which one of the departments to go first, but they already tell us here that canteen is to go first. Okay, so this here is merely to tell us that once we allocate the cost for a department, you don't bring that back in again. Okay, if you don't understand what I mean there, we look at it and then you let's see what we get in that. Let's get into it. Okay, so there are two ways we could go about doing this problem. We can start with a table and calculate the POHR and multiply them out in the table itself. Or we can do the workings here first and then just fill in the information in the table. Either way, it's the same thing. I prefer to do it this way so you can see the workings and then you see the answer in one, right? First, we calculate the POHR, the predetermined overhead rate for the canteen. We take the total overhead for the canteen and we divide it by the number of employees because that is the base we are using, and we'll get 400 per employee. Now, when we go to apportion the canteen, because say apportion canteen first, we will take the number of employees from canteen and multiply it by the 400 per employee. We get 58,000 for blended. Packing, we get 45, had 45 employees using the canteen, and we multiply it by $400 per employee, we get 18,000. The warehouse had 10 employees using the canteen service, so we multiply it by 400 per employee, we get 4,000. So these are the three amounts that would be apportioned from the canteen. If you notice, they would equal 80,000, right? Now, when we come to Do the same thing for the warehouse. We have to add on the 4,000 first that it got there to whatever it had already allocated. Okay, so we add on the 4,000 and we'll get 229,000 as the total for the warehouse. That's going to be a portion to the blending and the packing only. Notice canteen was already allocated here. It does not come back in. That is the here. That is how the step down method works. Okay, the ones that already allocated, you or a portion, we don't bring them back in again here with another amount. Okay, so we take the POHR, will be 229,000, the amount we got here, divided by 250 orders, because orders is the base that we are using here, and we will get 229 divided by 250 is 916 per order. So blended will get 916 by 160, well, 145,560, and packing will get 916 by 90. These two will total the 250 here, right? And that will be 82,440. And again, these two here will total the 229,000 here. So what we have done is taken the 229,000 and apportion them to these two different departments. Okay, while you're listening to the recording, you may find that there are times when I misuse the word allocation and apportionment according to the definition that we had in the previous part of the question. Okay, so you'll have to excuse me for that because I'm not going to go back and do over the explanation. Okay, let's see what the table look like. Okay, this is the table with the answer, and if you notice at the bottom here we have the total overhead costs, right, for blending and packing. Right, in a portion in the canteen, the first thing you would do is minus out the canteen by putting it in bracket. So when you take this, you get it here, 0. Right, and then you will put in the amount that you apportion to the blending and the packing and the warehouse. They would be normal figures, not in bracket, and they will be added on to get a subtotal here. Okay. Next, we will apportion the warehouse. The warehouse now has 229,000. We add only 4,000 from the 225,000. And again, we will minus out the 229,000 and we share it to the blending and the packing according to the number of orders. Then we add on these, we will get the total cost for the two production departments. These now would be apportioned to the units of production passing through these two departments. Okay, from here we couldn't get these two into the units because no units pass through these two departments. Okay, so we have to apportion it to the production department where the units are being produced, and we can apportion. So we can then take these here and absorb them, cost absorption, into the cost units. Okay, so I think that brings us to the end of this module. I will try to get you module 2 up if time allows, so look out for it. I hope you find this one interesting. It appears that though CXC has released the topics for the broad topics that they promised, and I will be putting out a video on it by the end of this week. Okay, so enjoy the rest of your night or afternoon, or whatever time it is at your place, and see you in the next video.